All right, yo, Section 6, Chapter 4, accounting defined equals a accounting of your money. So Section 6, Chapter 4, accounting defined equals a counting of your money. So let me read this quote. Office hours of small business owners open most days about 9 or 10, occasionally as early as 7, but some days as late as 12 or 1. Open most days. We close about 5:30 or 6, sometimes as late as 11 or 12. Some days or afternoons we aren't here at all. Lately I've been here just about all the time, except when I'm someplace else. But I should be here then, too. He's like a small business owner. Lately I've been here just about all the time, except when I'm someplace else. But I should be here then, too. Saying, unless he just dozes off. He's saying if you're a small business owner, you're working all the time. But shout out, this chapter is going to be extremely long, guys, probably about an hour. So accounting defined equals a counting of your money. Chapter 4. We're going to learn financial statement, balance sheet, income statement, cash flow statement, chart of accounts, your money through the eyes of others, business manager, CPA, banker. Case study 24A, Skip and Katrina. Double down for those non-gaming readers. To double down is a term for a strategy you might try in blackjack. You can make a lot of money if the cards fall right. However, you can also lose your entire doubled bet. In the case of accounting, doubling could cost you a lot. By this I mean don't gamble on haphazard record keeping and accounting. These lead to double trouble for you and your accountant. Haphazard record keeping, like lazy record keeping, feels like a burden on you when you think about records and numbers and stuff. It feels like it's hard on your heart, right? Skip, a young general contractor, showed up at my office with his pregnant wife, Katrina. They had just found out that the IRS wanted more than $90,000 in back taxes. Their current accountant, after charging them $8,000 in fees, had thrown up his hands. His contention was that their books, computer-prepared financial statements, showed that they had made that much money, and he couldn't understand why they disputed it. They were completely distraught. They claimed that they couldn't have made that much money. I reluctantly agreed to help them out. My reluctance was due to the fact that I had clients before claim that they couldn't owe taxes because they didn't have any money. That really meant they had spent money on items that they couldn't identify. After spending some time looking at their financial statements and interviewing their bookkeeper, I discovered that the bookkeeper really didn't have a better comprehension of how accounting worked than they did. When they invoiced the client, an entry was made to record the cash receivable crediting income. Okay, so when they invoiced a client, an entry was made to record the cash receivable crediting income, and when the client paid, an entry was made to record the cash and again credit income. Their income was exactly doubled for the year. No wonder the IRS thought they owed a lot of tax. Unfortunately, it wasn't any easy problem to discover or correct. The tax returns had already been prepared. Kind of like in plumbing when like they connect the pipes together, or they, like why is there no hot water? Well, it's because you connected a hot water line to a cold water line. So your hot water that's supposed to be hot, now there's cold water in that line, so it's not getting hot. So it's like right here, they said they found their income was being doubled because I discovered that the bookkeeper really didn't have a better comprehension, right? So when they invoiced the client, when they charged somebody, they put an entry, they made a record of it, of the money that they received. And when the client paid, an entry was made to record when they invoiced the client. Also, when they sent it out, they were already wrote down like as if they received money, but they didn't yet. But then they put another entry was made to record the cash, and again their income was exactly doubled for the year. No wonder the IRS thought that they owed a lot of unfortunately, it wasn't an easy problem to discover or correct. Well, yeah, because I had asked in my head, I was like, well, how did the IRS so they must have wrote down that they made $90,000, because he's saying the tax returns had already been prepared. That's the only way that could work. Also, unfortunately, Skip and Katrina continued to claim that they didn't want to learn any more about their accounting. And I'm sure that they still have overstated income. The key is to learn enough about accounting that you know you are doing the right things. Be willing to listen to your accountant and follow a reasonable record-keeping and accounting system. Knowledge of accounting can put money in your pocket, as illustrated in the following story. Case study 24B, the Marshalls. Pete and Sarah Marshall owned a small dealership. It was about 4 years ago that I suggested that they should consider starting a pension plan. The contribution would be about $6,000 per year. They almost fell off their chairs. There was no way that they would ever make that much money, but they agreed to pay careful attention to their books. They didn't really understand how to do financial statements, and so my firm prepared them on a quarterly basis. We met and reviewed the statements each time to look for trends, identify where they were making the most money, and protect taxable income. They didn't fully understand debits and credits, but they understood the importance of financial statements. The result, their company had netted more than $500,000 this past year. They have no problem putting away the $6,000 a year pension plan. Attention to financial planning does make a difference. Case study 24C, Matt. Let me spark my joint real quick. That's why it's gonna take an hour, because I'm just sparking my joint. Nice and put it. I'm blocking everything. I sleep in my car, so I'm blocking everything. But if you put an egg right here, it'll probably cook. So case study 24C, Matt. It's my middle name, Matthew. Another client, Matt Johnson, was a young land developer. In the beginning, working with Matt was like working with a sponge. He asked a lot of questions about profit and taxation. We also had quarterly meetings to look at how his company was growing. He worked hard at learning and running his business. Now in his early 30s, Matt makes an average of $750,000 per year. Will you be as successful as the Marshalls or Matt? Or will you be like Skip and Katrina and gamble your wealth, building power and sanity on careless record keeping and poor accounting practices? Take the first step. Pay attention to your business by learning the basics of good accounting principles. Key points. Count your money accurately with a good accounting system. Learn the basics of the 3 fundamental types of financial statements: balance sheet, income statement, and cash flow statement. Set up a chart of accounts properly. I'm reading this, but I'm not trying to fucking fool you guys. I'm broke and I don't know what the fuck. See your statements through the eyes of a manager, a CPA, and a banker. Set up a chart of accounts properly. Like your accounts, what you have open, like set up a chart of accounts properly. Like your different accounts, what you have to account for. Like, oh, I have a business. Oh, I do painting, so I gotta see how much do I spend over here at this paint. The guy that provides me with the paint, how much do I make over here? How much do I make over here? How much? These are all my accounts that I'm keeping track of. So I gotta know my invoices, particularly for those. But each account is not biological, is in alphabetical order in my filing sheet. And I go through each account that I have and get a number annually for what I'm spending there, and have everything nice and tidy, you know? So count your money. Accounting in its simplest form is simply counting the money. And who doesn't like to do that? People's eyes glaze over. But accounting, oh no, they exclaim. I leave that for my accountant at year end. The plain and simple truth is what you don't know can hurt you. You will face a much larger accounting bill and possibly a bankrupt company if you leave the compilation of your transactions for year end, which I was talking, compile all your accounts, you know? In fact, the least painful thing that can happen to you is that you face a huge, unexpected tax bill. The solution is to keep your own books, and it won't be too painful, I promise. Following this brief discussion of financial statements and accounts is the chapter entitled, Be State-of-the-Art, Computer Savvy, Plug It In. It tells you how to work with the computer program, a good computer program, and there are many good, inexpensive ones available. Will take most of the work out of this for you. Still, please make the effort to go through the next few pages. The brief overview will help you talk more intelligently about your business and its finances. Well, I'm going to read it. The brief overview will help you talk more intelligently about your business and its finances. Smoke some weed when reading gets restless, you know? That excites me. The brief overview, just the brief overview, will help you talk more intelligently about your business and its finances. When your banker or accountant asks you a question, you will be able to understand the question. Introduction. Every organization needs to keep good records to keep track of where money comes from and where it goes. The system you set up to do this is called an accounting system. Accounting then is merely a process of recording the cash flows, in and out, and other non-cash expenses. The end products of this system are reports on how your business has performed. These reports can take many forms, but the most common are financial statements. An accounting system must operate within certain well-established rules, which are called generally accepted accounting principles. We will be discussing these rules in greater detail in the next few sections. So let me go back. Accounting then is merely a process of recording the cash flows, in and out, money moving, and non-cash expenses. The end products of this system are reports on how your business is performed. Every organization needs to keep good records to keep track of where money comes from and where it goes. All right, so basic theory, the accounting entity. Accounting records for the business must be prepared separately for the accounting entity. In other words, the accounts for your business must be kept separately from those of your individual accounts. The accounts for your business, yeah. Like I said, going back, if you sell produce, those are your accounts. Or where'd I get this produce from? Where'd I get that from? Where'd I get, my bags that I spend on my business every day? Where'd I get those from? How much am I paying here? Those are your different accounts that I have, So you got to keep those separate from your individual accounts. Money management, accounting records, income. Money management. Accounting records, income, and expense in terms of money. The value is shown as a historic value. In other words, if you buy an asset for 1,000, it will be recorded as 1,000. If later this asset appreciates to 2,000, your records will show the value at 1,000. So accounting records, income, and expense in terms of money. Accounting records, income, and expense in terms of money. The value is shown as historic value. In other words, if you buy an asset for 1,000, it will be recorded as 1,000. If later this asset appreciates to 2,000, your records will show the value at 1,000. So now we have double entry. I wonder, when do you document it that it has appreciated in value? Because it says your records will show the value at 1,000. Well, from that particular time in history, no? Okay, so double entry, and then there's an end quote at the end of this page. So double entry. For now, keep in mind the following principle. Each transaction affects at least 2 items. There will be a debit and credit to each transaction. Double entry. Each transaction affects at least 2 items. I don't know what he means by that. For now, keep in mind the following principle. Each transaction affects at least 2 items. Oh, he's going to teach us. So he's saying just keep in mind. Each transaction affects at least 2 items. For later, I think he's going to teach us something different. There will be a debit and credit to each transaction. So let me read this end quote. Knowledge is of 2 kinds. We know a subject ourselves, or we know where to find information upon it. Knowledge is of 2 kinds. What we already know, and where we know where to go to find what we want to know. All right, cool. By Samuel Johnson. Maybe he's a prosperous man. So, financial statements. There are 3 basic forms of financial statements. First, a balance sheet. This is a statement that shows the resources and claims against those resources at a given period of time. In other words, the assets what the company has and liabilities what the company owes. Since the statement needs to balance, hence the name balance sheet, the difference between these two amounts is shown as equity. What we have and what we owe. So equity. Equity, the difference between these two amounts is shown as equity. The second statement is an income statement, a profit and loss. This is the financial statement that most people easily recognize. It shows income and expenses for a period of time. For example, the 12 months ending December 31st, 2002. The third statement is the cash flow statement. So balance sheet is what your profit and its liabilities. So it's asset and liabilities. That is the balance sheet. The balance sheet is of the assets and the liabilities. And the difference between the amount of those is your equity. That is your assets and liabilities. Then you got the income statement, profit and loss. It shows income and expenses for a period of time. The third statement is a cash flow statement. The cash flow statement is not needed for preparation of the tax return, but it is a useful statement for management purposes. It shows cash inflows and outflows due to operations, financing and investing activities. Now let's discuss each of these statements in more detail. You're gonna put me to sleep, son. Shit, I guess I gotta read it, right? I won't go past 20 and I'll just have to do another part to it, you know? I'll just finish the, let's go, Well, I'll end it right there, you know why? Because it's saying we're going to go into something new, so end it right there, y'all. Peace. Till tomorrow.